Hi, welcome to this short video. I'm Stuart Porter, Chartered Financial Planner. This video looks at one of the most important services I provide, fixing broken investment portfolios. Recognizing when a portfolio is broken is not easy. It may be just a feeling that your money is not working quite as hard as it could be, or perhaps it's not invested in a way you're comfortable with. Knowing when your car is broken is easier. With a car, it may not start, or there may be a strange sound when it's running. Broken investment portfolios tend to fall into one of three categories. They can be set up wrong. To continue the car analogy, this would be a bit like taking a saloon car on a dune bashing trip in the desert. You'll probably get stuck early on and require a 4x4 to pull you out of the sand. Another scenario may be that they were set up correctly, but something's changed. This could be a change in your circumstances, feelings, or the purpose of the investment. Regular servicing of your car should result in fewer breakdowns and better ownership experience. The same can be said for investment portfolios. Sometimes the change is so fundamental that a complete change is required. For example, when you retire, what you want from your portfolio will change from growth to income and some growth. External changes include taxation, legal, market and economic factors. Whilst nothing may have changed in your circumstances, financial services is a fiercely competitive sector. This breeds competition, which delivers innovation. This is often beneficial for you, the investor. For example, competition has led to greater transparency and lower fees in many places around the world. Lower fees mean you can keep more of the returns on your money. It also means that you can take lower risk and achieve the same result, all things being equal. In this video, we'll look at how you can tell if your portfolio is broken and some of the red flags to look for. I remember when I met Sarah and David. They were in their late 30s with a growing family. David had started investing in shares because his income had been rising and now he had a bit of spare cash. He wanted to see it grow. He bought shares based on tips from online platforms, social media and from friends. And when we spoke, he had more than 30 different stocks and spent hours every week following news feeds about them and poring over accounts and other financial statements. The portfolio grew at a fantastic rate for the first few years, and encouraged by his early success, David invested more money until they had a substantial sum invested. Then COVID hit. Their paper losses were significant and they were not sure what to do. Sarah just wanted to sell everything and leave the money in the bank, as she did not like the volatility associated with shares. Given the losses that this would involve, David wasn't keen on doing this at all, and so it became a sore subject between them. At this point, David contacted me to ask for my help. Whilst David's idea of investing in shares was a good one, it lacked a purpose beyond accumulating wealth. Before we dig into some of the technical aspects of portfolio construction, it's useful to know why David was investing the money the way he had. Building a portfolio is a process which first requires an investor to know why they're investing. In my experience, the clearer you can get on this point, the greater your likelihood of investment success. This is because you have a long-term objective which is less likely to be swayed by short-term market fluctuations. After some work, David and Sarah put together the following statement of financial purpose: to have control over our work, family, life balance, and to build a secure future for our family. You'll see that for David and Sarah, spending every waking moment at work to generate more income was not the most important thing for them. Having a balance between work and family life was vital. Recognizing the time they have together as a family to create lifelong memories is precious, and the kids would soon reach an age where they no longer wanted to hang out with mum and dad. Referring back to this statement of financial planning purpose makes their decision making easier, not just their financial decisions, but also for family life. This includes the investment strategy we agreed together, which was their next step in fixing their portfolio. Having decided on the why, we now turn to the how. This is a bit more technical, but there are several key facts almost universally recognised. First is that being diversified across different types of investment asset is a good thing. So, for most investors, holding some cash, fixed income, property and shares is a good thing. Second, being overly invested in any one of these limits future options and increases risk. Putting together an investment strategy starts with understanding what you want to achieve. In David and Sarah's case, they were looking for investment growth. They didn't need income as David's salary more than covered their living expenses. Additionally, if they received income, they would just have ended up reinvesting it, which would have cost them more in fees. The length of time an investor intends to invest for is known as their time horizon. Typically, this is at least 5 years for investments like shares. In David and Sarah's case, they knew of several life events which they would need to plan for. This was because they knew they would not be able to afford to pay for them out of income. The first was their children's college fees, which were about 15 years away. The second was for David to take a sabbatical for about 6 months to write a book. And the final event was for them to move back to the UK in 20 years' time when they wanted to retire. Another increasingly important factor for investors in preparing their portfolio is the environmental, social and governance credentials of the firms they invest in. David and Sarah were interested in this idea, but ultimately rejected it as they did not want to limit their investment choices. In normal life, we try and avoid risk as much as possible. However, when it comes to investing, there is no return without risk. Therefore, the strategy needs to be to understand the risks being taken and to monitor them closely. There are 3 elements of risk which all investors must consider. They are their psychological ability to withstand the changes in their investment value, also known as the "can I sleep at night" test, the economic impact on their lives if the investment underperformed, i.e. are they investing their life savings or a small percentage of their wealth, and the level of risk they need to take to potentially achieve their desired goal. Lower risk investments have lower potential returns. If higher returns are required to reach a goal, sometimes a compromise is required. Once the above factors have been considered, it's important to have a plan for what you want to do in certain situations. Thinking through various scenarios helps you make the right decision if that situation arises. This is what an investment plan is designed to do. For example, what would you do if your investment portfolio fell by 20% or more in a few days? Would you see it as a buying opportunity if you had spare cash? How often will you review your investments? What impact would the loss of your job have on your investment? Would you need to cash in some or all of it? How would your plans be impacted if you became seriously ill? Worse still, would your family be financially secure if you died? Many of these scenarios trigger a flight or fight response in us, which is a stress response. A lot will depend on the specific circumstances, but academic research has shown investors make more rational decisions, which in turn result in better outcomes for them when they are not stressed. Therefore, writing down your thoughts when you're not stressed so that you can refer back to them can be a valuable exercise. Of course, if an investment grows faster than expected, you may need to review your plans too. It could be that the investment strategy of the fund has changed and now represents higher risk, or the strategy just could have been more profitable than anticipated. What would you do in this case? Invest more, take some profit, or diversify your portfolio? There are many potential scenarios to consider. It is possible the reason your portfolio feels broken is that you're experiencing one of these situations now. So you should now have a good idea of why you're investing, what you want to achieve with your investment strategy, and some notes to help you make the right decisions if things take an unexpected turn. If you're concerned that your portfolio may already be broken, the next few pages highlight some of the potential red flags which would warrant further investigation. I've found 7 common investment types generally marketed in the UAE, which often form part of a broken portfolio. These types of investment are not all bad, but a significant number of them in these categories have experienced problems in the past, and so contributed to broken portfolios. Therefore, additional care should be taken before investing in them, and, if they're held, the risks associated with them thoroughly investigated, as they're not always easy to spot. The first is investments registered in countries outside of highly regulated jurisdictions. Here, there are advantages for the investment manager. In domiciling an investment outside of a highly regulated jurisdiction, registration fees are generally lower, and there's less red tape in the form of regulation. Often this means more freedom to invest in esoteric assets, which would not normally be permitted in other more regulated jurisdictions. Another type is professional or qualifying investor funds. This type of investment is reserved for people who are very wealthy and understand the potential risks their capital will be exposed to. Whilst the minimum investment amount may be $1 million or more, I have seen investment platforms pool their investors' money to meet the minimum and so circumnavigate one of the safeguards associated with the regulations surrounding this type of investment. Shares and fixed income securities like government debt can be converted to cash very quickly. This is because there is an active market pricing the value of these assets every minute of every day. One of the valuable services a stock market provides is the pricing of a company's shares. Generally, no single investor can influence the price. Some investments hold assets which do not have active markets and so rely on a marked-to-model method of pricing. The accuracy of this method of pricing can quickly falter when there are stresses placed on the assets, such as an unusually high number of people wanting their money back. Other investments hold esoteric assets which have a limited number of traders. Examples are collectibles like cars, art, wine, coins and watches. This means that prices are difficult to determine and there is the potential for price manipulation. Some assets, whilst commonplace, are not readily converted to cash. They have low liquidity. A common example of this is real estate. Whilst most shares can be converted to cash in minutes, selling a property can take months. Many funds investing in property hold a cash reserve to manage redemptions, but occasionally the number of redemptions can exceed these amounts and funds are frozen, even in highly regulated jurisdictions like the UK. A potential solution to this is the Real Estate Investment Trust, or REIT, but this structure is more volatile than the traditional property fund. Structured notes are a commonly marketed form of investment in the UAE. Typically, they promise a return of capital and some growth, provided an event does not occur. These products rely on financial instruments called derivatives. A key component in the pricing of derivatives are interest rates. With low interest rates for over a decade, the risk-reward balance with these products has generally not been favourable to the investor, and many are locked into contracts which are costly or impossible to break. However, with rising interest rates, it is possible these investments will become useful once again. Hedge funds have generally had a bad press. However, they should not be dismissed as an entire investment idea. This would be like saying all exchange-traded funds or ETFs are a bad idea. There is little consensus as to what a hedge fund actually is. However, they are typically professional investor funds, which I've described earlier, and they are also generally small in size, managing less than $1 billion. Because of their investment strategies, they are also often located in exotic locations. Sometimes people want to know a little bit about me and my background. I'm originally from the UK and I've been working in the financial services sector for over 30 years. This equates to about 50,000 hours of experience in helping clients with their finances. I hold a first-class honours degree in financial services, I'm a chartered financial planner and a fellow of the Personal Finance Society. The last 20 years or so have been in the UAE, where I've appeared on radio shows and in the national press. This experience has given me valuable insight about what makes expats like you feel secure and vulnerable financially. This means when planning becomes necessary, I know how best to help you. I believe in working in partnership with you so that you can live the fullest life possible. My service saves you countless hours every year so that you can spend more of your time doing the things that make life worth living. I have a proactive approach, keeping you informed of relevant developments, preventing financial mishaps, and helping you progress towards agreed objectives. With an eye on your circumstances, I can make sure that you are ready for life's important transitions, such as retirement and relocation to your next expat posting. Over the years, a number of clients have been kind enough to provide me with testimonials. Here are a few, and more can be found on my website, stuartporterfinancialplanning.com. As a partner at AES Wealth, I work for the only independently audited fiduciary investment advisor in Asia, Middle East and Africa. As this video shows, a fiduciary places your needs before the commercial needs of the firm. AES is also the only fee-based advice firm in the GCC. I've been Stuart Porter. Thank you for listening and watching. Please use the contact details on this page to get in touch, and don't forget to like and subscribe.